Welcome to Ambit 365's webinar for this month. Um, we will talk about what we think about the markets, what we did to the portfolio, the changes that we have done in the last 2 months, last month and a half, how we are doing, where we see the markets going forward. We are calling this webinar Winds of Change Part 3. This is the third and the final uh, series in our Winds of Change thinking process. So we wrote about Winds of Change for the first time in the month of June. And we've been writing about non-linear markets right through Jan till May. So just to give a little bit of a backdrop on that, when we talked about non-linear markets, Jan to May, markets were very, very choppy in a 3 to 4% band, both up, down, very volatile. Typically, high volatility shows that the conviction in the current prevailing trend is weakening, but that does not necessarily mean that the trend will change immediately, because a trend change normally needs a catalyst, even though the trend is weakening. And the catalyst came in the form of weaker than expected election results outcome for the ruling government in the month of June. Month of June, markets were very volatile, both up and down, eventually closed 7% up. But that catalyst set into motion the cycle for a sector rotation. So just to reiterate, Sahil, can you go to the next slide? Just to reiterate, and also apologies, you will see Rahul Maheshwari name against my window. My name is actually Dheeraj Agarwal. There was a little bit of a tech problem today, so both Rahul and I have joined on the same link. Rahul is my colleague and co-fund manager on the product. So we'll come to the returns a bit later. Now, can you just skip all of this and just come to Winds of Change Part 3? Yes. Thank you. So just to reiterate, the 2 or 3 trends which were strongly in force for the last almost 2 years was IT sector was weakening. There was continuous disappointments in IT numbers, and hence IT sector was underperforming. Consumption was really weakening. Volume growth in FMCG came down from high single digits, 7-8%, all the way down to just 2 or 3%. Rural demand was very, very weak. And capex was booming, led by the government capex, and the capex growth CAGR by the government of 16-17% per annum. So all the capex oriented companies were really doing well. PSUs were the focus. What the election results actually did was set a motion in change for reversal of some of these trends, partly also depending upon where the valuations for these sectors finally settle down to what's happening in the US as well from a global point of view. So one was the government realized after the weaker than expected performance in the elections that they underprovided for boosting consumption in the economy, and they were focusing only on the capex. So in the final budget, which was presented in July, as compared to the interim budget, which was presented before the elections, additional allocation was done for consumption, and the consumption growth in the government expenditure. Rahul, jump in here if my numbers are slightly off, which was only 3% or thereabouts in the interim budget, went up to 7% approximately after the revised budget. And the government managed to find finances for boosting consumption in all the consumption programs because of extraordinary and more than expected RBI dividend, which was 1.5 lakh crores as compared to an expectation of only 50,000 crores. In addition to that, many of the companies in their commentary had already indicated that they are seeing green shoots for demand revival, especially on the rural side. So this government allocation will be an additional boost beyond that. And this sector is seeing clear signs of a turnaround. We have seen that in the company commentary. We have seen that in the micro data, which is coming. Second, we picked up early signs of revival in IT sector, looking at the hiring trends. So the net hiring for IT sector, which was in a negative territory, which means just stay on this slide for some time. Then the We will come to more details here. So I'll just stay on the master slide only. I'm just giving one point summary here.
Sure.
So we picked up early signs of a pickup in the IT sector hiring trend and predicted a turnaround in the sector, which is doing really well. And partly because the markets are both absolute and relative, right? So while industrials and capex is still doing well, but in a relative sense, some of these other beaten down sectors, cheaper on valuations, are showing signs of turnaround. There is a high possibility of some amount of sheen coming off on the previous high growth sector, which is capex oriented in industrials, and we predicted a consolidation. But before that, before we actually jump into a little bit more details into the sectoral composition, uh, I would also like to highlight a global risk. Sahil, can you move to the next slide? So this risk for now is postponed, but the trailer or the curtain raiser that we saw on August 5 is a risk that we should keep in mind for. So what happened on August 5 was that on the weekend or on Friday on the weekend, Bank of Japan increased the interest rates from 10 basis points to 25 basis points and indicated that there could be further increases to the interest rates in 2025. This resulted in a global sell-off. Nikkei fell on the same day by 12%. Many of the global markets were down between 5 to 7% on a single day. Nifty opened 2.5% gap down, closed about 3.5% down that day. The next day, because of the sharp fall, and yen appreciated by 10 or 12% in just 3 or 4 days time frame, which is a huge move considering it's the second largest or the third largest currency in the world. Bank of Japan immediately the next day came and tried to soothe the markets by saying further rate increases will happen only when the market conditions are stable, and the markets globally started stabilizing after that. But why this is significant to keep in mind from a medium term point of view, this chart shows Japan's foreign investment flows in the last few years. And this stock has increased from about 300 trillion yen to 500 trillion yen in just 4 years time frame. And notice that before that, for almost 5 years, it was between 300 and 350. So there's a massive move from 2018 till 2024, so 5 or 6 years. 200 trillion yen is approximately 1.5 trillion US dollars. And what underpinned this was a massive depreciation in Japanese yen. It moved from 100 to 160. So in these 6 years, any offshore investments from Japan made 60% return just on the currency depreciation. And then you add on top of that whatever returns they would have generated either in US bonds or US equities. Some of this money in the last 2 years have come to India as well. Thankfully, not very large at this point of time, not as large as what happened in 2007. And hence, for India specific, it may not be that large a risk, but it's still a risk. And hence, let's say come 2025 or end of this year, if Bank of Japan does increase to start touching the interest rates again, coupled with the fact that US will start cutting rates from September. So two things will happen, right? Bank of Japan will raise rates, US will lower rates, and hence the interest rate differential between US and Japan will keep on narrowing. And that can result in a significant part of these flows moving back from offshore centers into Japan. Some dislocation in financial markets globally is inevitable when once that happens, but that risk is perhaps a few months away. And for the time being, Bank of Japan has taken care of this risk. Nifty is almost also back to the previous high. So is the US market. So recouped all the losses of that day. But this risk is something at the macro level we should keep in mind. Sign next. So this is a little bit more detailed illustration of the three winds of change trends that we are talking about: IT uptrend, consumer uptrend, and consolidation in the industrials. Rahul, you want to take this?
Yeah, sure.
So take these three slides, and then we will come back to the
Yeah.
fund and fund performance.
So just to continue with what Dheeraj had alluded and what we are writing from past three newsletters, the one of the biggest contributors from our identifications, and now finally we are witnessing the change also on a broader market. Is IT is one of that sector where we were able to find green shoots not only in the numbers but also in the commentary and the narrative that had been planned. Two biggest trends which we wrote many of times in our newsletter is one of the hiring data. We are witnessing that from past 4 quarters on a trailing basis. If you look at the top five companies in the IT index were witnessing a declining run rate in the net hiring basis. And from past quarter four, it had bottomed. Uh, this was one of the first quarter where we had witnessed in most of the IT names the net hirings turning into a positive number. Wherein, in fact, we had witnessed a few of the companies like TCS and Infosys giving out the guidance that whatever the hirings which were halted for a time being in FY23 because of the too much layoffs that had taken place. They will fulfill the entire demand that had been taken place. So first thing, the hiring data, as you can see from the first chart, which is Naukri Job Speak Index, it is the chart is on an uptrend basis, and that gives the positive that whenever the company is on a net hiring basis, it first of all highlights the visibility and the demand coming back. And few of the narratives which we found out from the companies were that three broader trends which we took was first and foremost that the BFSI, which was the most struggling part and contributing to the majority of the company's revenue mix, have found a rebound, especially in few of the segments in the mortgage and the credit cards, etc. segments. So across companies, we had witnessed a positive, not in fact just the narrative, but in fact the growth has now come back into a positive regime, at least into the BFSI sector segment. Second, the bigger thing which we have witnessed that the North America, which is one of the largest segment, has again the companies come and said that whatever the discretionary demand cuts that were taking place has been moderated, and the inquiries levels have started increasing. So that was one of the area. Europe still struggles, as you can see that Europe among all the nations is going through a more rough patch compared to the rest of the economies. And third, one of the biggest thing which we had highlighted that many of the companies had given a beat compared to what their estimates were there. In fact, few of the companies coming and saying that FY25 they are expecting better than the FY24. So combining when we see all these three trends and narratives that have been built, it gives more confidence, and that is being reflected in terms of the re-rating and the earning upgrades within the IT sector, which we have seen. And we continue to maintain that there would be selectives within the IT which will be delivering much better. Overall, if we look at FY24, where the PAT growth was very in a low single digit, next 2 years we are going back into a high single digit to low double digit run rate of PAT, at least in the top tier. But in few mid tier companies like Persistent Emphasis, where the growth continues to be in a mid teens kind of thing, and they continue to get that kind of valuations. So this is on IT, and we continue to maintain the stance that the uptrend will be there. As and when we will find opportunities of profit booking, we are continuing to do this. But on a longer term, we remain positive. Yes, I
Yeah.
can go on. Yeah, just on FMCG, just to start, like in a
In
recently
fact,
when
Rahul, before that, Sahil, I just want to show the previous picture. So, I mean, on consumption, we as a house are bullish. Just to point out that just about 10 days ago, our team had written a fantastic newsletter. And those of you have seen it, great. Those who haven't missed it and they want to see it, please write to us. We'll send it to you again. Fantastic newsletter on capex to consumption. Has a shift begun? This newsletter has a lot of data justifying why we see little bit of softening in capex. We are not saying a slowdown in capex, but a little bit of softening in capex and some strengthening in consumption. And markets are always a bit of a second derivative. They always want to look at the rate of change and not just the absolute quantum of change. And if the rate of change of consumption is let's say declining even marginally, sorry, capex is declining even marginally, and rate of consumption, so dy by dx for let's say consumption is picking up, this will result in clear shift on which sectors will perform. We see the pendulum swinging. This is certainly a mid-cycle trend, whether it is a structural 3-year, 5-year trend, who knows at this point of time. But looks like this will certainly be, let's say, a 12-month kind of a trend. Obviously, not linear. It'll give pockets of ups and downs kind of opportunities, but seems like it's falling in place. So just wanted to highlight uh, this newsletter as well, which we wrote about 10, 12 days ago. Next slide, please. We'll present some more granular data on why we think FMCG is a trend. All back.
Yeah. So just to start with FMCG, I think so. Just to continue what Dheeraj had alluded, after a 5 years of trend, we can witness one broader change in the macro. That in this recent union budget, the government has given a 10% growth in the rural development compared to a flat growth in FY24, which is there. So this is one of the bigger change in terms of the stance by the government that has taken place on a macro level. But if you go into the micro within the companies, in recently when someone asked in the con calls or during the earnings season to Mr. Mohit Malhotra, who is the MD and CEO of Dabur, that how you see the recovery trends in the consumption basket. So the common reply being given that by him that if I imagine myself, I'm the lead indicator of the entire rural play in India, and I'm witnessing the green shoots very strong. So picking up from all the narratives and from the chart above, after a long period of time, as you can see, the FMCG volume growth have now started inching compared to what it was flattish. It has come to a 5.6% as an industry level volume growth that has taken place. And more importantly, the overall volume growth is more broad based in nature. It's not coming from few pockets or skewed towards one segment, etc. So that is more positive. And across companies, there is a volume growth which was languishing around a flat to low single digit. The volume growth across companies has moved to a mid single digit. And also, as per the guidance given by the company, it gives further more confidence that going ahead, the pricing growth or the margin tailwinds all are back. But now the clear focus for the companies, for the management and the market is looking at volume growth. Few of the key bigger trends which we picked up is one, that after 4 quarters of time period, if you look at rural volume growth is stronger than the urban volume growth. So this was one of the key highlight which we picked across most of the companies. And second bigger thing that has been taking place is the we have witnessed in the past 3 months that the monsoon has progressed well. The sowing data is good. And third, which we recently told about the government allocation. So all these three combined together gives more confidence to us that now the volume growth, which was the missing piece in the entire FMCG, that will be the more driving factor for the earnings growth and the valuations to take place. So we continue to maintain our stance even on FMCG and consumption as a border pie. Even if you look at, for just to give you an example, like within the broader aspect of consumption, like QSR companies, Jubilant Foodworks, after a 7 quarters, almost 2 years, if I say, is witnessing a positive same-store sales growth. The order volume growth is coming back because of the initiatives which the management is taking place. So it's not just restricted to the FMCG side, but we are witnessing the green shoots and the narratives that is building across the consumption, whether it's QSR, whether it's retail apparels, or whether it's the discretionary companies among the subsegments. Yes, I. And last but not the least, this was last month newsletter, and even in the I would say the webinar we had said that ABB is one of that name which we, as Dheeraj had highlighted, we take that as a poster child, and we try to do relative valuations of ABB compared to the rest of the sectors, like within pharma, within FMCG, or within other segments. after a long time, we are witnessing that in this sector, as we said, valuations move in line with what the earnings growth is there. And finally, we are witnessing the decelerating run rate of growth in the industrial segment. What the order book growth or the which was growing at a mid-teens at about 20-25% has now started decelerating to 15% run rate, and that gives us that there will be bit of a pullbacks into the guidance, especially, and more importantly, these companies are trading at a 25-year all-time industry high margins, and that's a matter of chance. And also the company's management has said that these kind of margins are unsustainable going ahead. So we witnessed that when we look at back the earnings plus the narrative that is building up, the valuations, as you can look at, is at a 4 standard deviation plus. It generally doesn't get sustainable. There will have to be some cooling off because of the deceleration that is taking place. Even if you can look at ABB's premium to the Nifty is almost at a 5 times. So that gives a lot of thing that why we are building our short bias towards the industrials, because of its expensive. And the reason why we saying that expensive, not only because of its valuations, but also the fraud that has got too much in valuations. If you look at it from our earnings also, it will now start decelerating, which it was growing at a 30-40%, it will now start growing at a 20% type of run rate, which is, I would say, a more normalized run rate, not a high growth phase type of companies, which deserves a premium multiple.
Thanks. So,
Dheeraj, can you take this?
yeah. So, I mean, this slide in some senses represents a pictorial representation of where we place different sectors and where we place different companies on a sine curve framework. Uh, so the left side of the slope indicates acceleration. We are seeing acceleration after a little bit of turnaround, some amount of acceleration in IT companies. Uh, Discretionary, we are saying, is already in a fast-moving mode. I mean, Titan being placed right at the top doesn't necessarily mean it's stopped out. It basically means it's in a very high acceleration mode, and at this point of time, this acceleration can continue. We are seeing some amount of slowdown beginning to start, as Rahul pointed out, in industrials. This is now getting visible in analyst forecasts for earnings for next year as compared to last 2 years, as well as data in terms of order inflows, etc. Metals pretty much close to the bottom, and on the right side of the curve, as we indicated earlier, we are seeing revival in consumption. FMCG, we are pegging slightly higher than some of the really beaten down names like Page and Jubilant. Both have suffered for almost 2.5, 3 years. Stock prices have seen cuts of 30, 40, 45% from the peak to bottom, but both are showing very early signs of revival. So out of these, just to give an indication of what's there in our current portfolio, on the consumption, on FMCG side, we have HUL and ITC. We are thinking of adding Dabur to it at some point. On discretionary consumption, we have Jubilant Foodwork. On high growth consumption, we have Trent and Titan. So a lot of consumption plays in the portfolio. We also bought Havells as a consumption play, particularly for their brown goods portfolio, because that's more semi-urban and rural centric. And while the white goods have done broadly okay, brown goods have been under pressure for the last 2 years in terms of demand slowdown. So we are seeing signs of revival on the brown goods side. Havells is one, a very nice integrated play. We are currently not short on any industrials, but we are thinking we had shorted and made some money on ABB and Siemens in July. And then we stepped away, we booked some profits, allowing the stock to bounce a little bit. But those are in our short horizon, and we'll probably short them again at an opportune time. Yeah, we don't have any bank at this point of time on the long side. We just have one simple play, BOB, because Bank of Baroda has consolidated very, very nicely. Banking, we are seeing at this point of time largely as range trade candidates. So no structural upside, but range trade. When it drops 10, 12, 15%, one can buy for a small trade up and vice versa. So It's stuck in a range. It's getting continuously derated on the valuations. We don't want to fight what the market trend is. We'll see how that plays out going forward. Sahil, can you now go to the return slide? Thanks. So, repositioning of our portfolio on the right side of winds of change did very well for us in the month of July. July, we were 2.5% up, taking our since inception return, which completed 10 months in July, to 15 and a half gross, in line with a guided target of 18. In August, because of the sharp fall of the market on the first day and then slow and then slightly faster revival towards the end, the book is at this point of down 2%. But I don't worry too much about that because we are positioned in the right side. I mean, the way the markets rolled over, global markets particularly rolled over on August 5th, it did appear that a deeper cut is around the corner. It reminded, I mean, many commentators write that this was reminiscent of the Black Monday of 1987. And it did appear that it will follow through. So we built short positions. We really reduced our long positions and shorted Nifty as well. All of that contributed to collecting a minus 2% kind of a return for the month of August. But our current positioning in IT, consumption, and one or two slightly outlier names like BOB, etc., and we have HPCL betting on the softening crude, is working slowly. I mean, by end of this month, I'm hoping to claw back to either neutral or slightly negative. By the end of September, we will do 17-18%, which is what we had guided. So a little setback in August, but I won't worry about it too much. So that's where we are. We think the trends that we are seeing at this point of time is here to stay for 6 to 12 months at least, more likely 12 months rather than 6. So the portfolio and the positioning will look very, very different from what we had done in the last 9 or 10, where we had been continuously negative and short on consumption and long on capex. This is time for a reversal. We are long consumption. We are not wholeheartedly short on capex yet because many of the stocks are in the process of top formation, but haven't really completed that sign. So whenever a cycle turns, it takes a little bit time for strong performers of the past to start weakening, because the usual investor tendency, whenever there is even a 3, 4, 5% cut, is to say, these names you've bought every 5% dip in the last 2 years and it's really worked. So sort of demand starts coming in. Till the time you realize that the fundamentals are not supporting, there's another segment of the market which is meaningfully outperforming, and hence money structurally starts to move out into newer sectors, which are where the fundamentals are rotating into as compared to the sectors of the past, or the legacy sectors as we call them. So right now the book is long biased. We have about 40% Nifty long. We have about 20% net long in stocks. We will nudge our net long in stocks down slowly as more and more stocks confirm reversal. We try to use a little bit of technicals confirmation along with the fundamentals to time the entry, and we're waiting for the right timing to build our short position. Maybe by end of next week or early part of September, we will get those triggers and we will build short positions in a gradual manner. So that is all from my side. Sahil, we can open the floor for Q&A.